When it comes to tracking the stock market, two of the most well-known indexes are the S&P 500 and the Dow Jones Industrial Average, DJIA. Both represent the overall performance of the stock market, but they have different compositions, methodologies, and uses. Understanding these differences can help investors make better decisions when analyzing market trends. What is the S&P 500? The S&P 500, Standard & Poor's 500, is an index that includes 500 of the largest publicly traded companies in the United States. It is considered a broad market indicator because it covers companies from various industries, such as technology, healthcare, finance, and consumer goods. The S&P 500 is weighted by market capitalization, meaning that companies with larger market values have more influence on the index's movements. For example, a big change in the stock price of a large company like Apple or Microsoft will affect the index more than a change in a smaller company's stock price. What is the Dow Jones Industrial Average, DJIA? The Dow Jones Industrial Average, commonly referred to as the Dow, is an index that tracks 30 major U.S. companies across different industries. Unlike the S&P 500, which includes a wide range of companies, the Dow is more selective, focusing on large, established companies that are considered leaders in their sectors. The Dow is price-weighted, meaning that a company's stock price determines how much impact it has on the index. A stock with a higher price per share has a greater influence on the Dow's movements, even if it has a smaller overall market value. Key differences between S&P 500 and Dow Jones. Number of companies and market representation. S&P 500 includes 500 companies, making it a more comprehensive representation of the overall stock market. Dow Jones includes only 30 companies, meaning it represents a smaller portion of the market, but focuses on blue-chip stocks, large, well-established companies. Weighting method. S&P 500 is market cap weighted, so larger companies have a bigger influence. Dow Jones is price weighted, meaning stocks with higher prices have more impact, regardless of the company's total market value. Industry representation. S&P 500 covers a diverse mix of industries, including technology, healthcare, finance, and energy. Dow Jones is less diversified because it includes only 30 companies, and some industries are underrepresented. Which one is better? It depends on what an investor is looking for. Choose the S&P 500 if you want a more accurate representation of the stock market as a whole, a diversified mix of companies, and a market cap-weighted index. It is often used as a benchmark for long-term investment performance. Choose the Dow if you want to track a smaller group of established companies and prefer an index that historically has less fluctuation in extreme market conditions. The Dow is often seen as a measure of big business stability. Conclusion. Both the S&P 500 and the Dow Jones are valuable indicators of the stock market, but they serve different purposes. The S&P 500 is broader, more diversified, and a better indicator of overall market trends, while the Dow is more focused on large, stable companies and is more sensitive to high-priced stocks. Investors often follow both to get a complete picture of the market's performance.